What's up, everyone? This is Taquan with my honest opinion, bringing you guys back with another finance-related video. And today we're going to be talking about ETFs. Now, as a quick disclaimer, I personally trade ETFs. I love them. They're highly liquid, and we're just going to be touching on today about the quick points about what an ETF is, what are the key takeaways of the ETFs. What are the key takeaways of an ETF? And why I like them over other types of investment vehicles, as far as dealing with like stocks and stuff like that. So let's just get started. So what are ETFs? Exchange traded funds is a type of pooled investment security that operates much like a mutual fund. Typically, ETFs will track a particular index, sector, commodity, or other assets, but unlike mutual funds, ETFs can be purchased or sold on a stock exchange the same way that a regular stock can. An ETF can be structured to track anything from the price of an individual commodity to a large and diverse collection of securities. ETFs can even be structured to track specific investment strategies. How is an ETF created? ETF creations involve a financial company known as a sponsor which buys a basket of stocks that represent the holdings of the ETF. These shares are put into a trust and the sponsor issues ETF shares that represents the value of the portfolio of these holdings. The ETF shares then trade on the open market where their market price may diverge from the net asset value of the portfolio itself. And usually when this happens, they issue new shares just to kind of keep the actual value of the ETF in line with the value of the underlying securities of the ETF. Sometimes you'll see, it's common that you'll see sometimes the ETF, if it's supposed to, let's say, for example, it's supposed to trade at $1. You may see it sometimes where it's trading at a dollar and 2 cents, or maybe trading under about 2 cents at like 98 cents. That's common just because of sometimes people are paying a premium, and it can move around like that within a range, but you don't want to see an ETF so far diverged from the actual value of the underlying securities that it's holding. Just kind of stay away from that. So why are ETFs important? ETFs provide lower average costs because it would be expensive for an investor to buy all of the stocks held in an ETF portfolio individually. Investors only need to execute one transaction to buy and one transaction to sell, which leads to fewer broker commissions because there are only a few trades, or one trade, or two trades if you're one buying, one selling, that need to be done by the investors. So with this, today you really don't see any brokerage firms that charge commission with trading, equities, right? Uh, you shouldn't see any fees also charged with trading ETFs because it's treated just like a stock. It's traded on the open market just like that. Two, let's say for example, as an investor, you wanted to own every company that the S&P 500 holds. You can go trade ETFs such as the SPY, which is from the sponsor of that is State Street, but the SPY is one of the most highly liquid ETFs that's traded essentially every day. And you can buy the SPY versus buying one share of the S&P 500. So the SPY be essentially 1/10 of the size of the S&P 500. You can go and buy the S&P 500 itself and then just get exposure to all of the 500 companies it holds within that the index itself. So they essentially be buying the index, or you can just go buy the SPY, which is the ETF or derivative of the S&P 500. Which also that brings me to my next point. ETFs have lower barriers of entry compared to index funds. No minimum investment required, and it has lower fees. Exchange traded products which we'll touch on later in this presentation, are available for all asset classes. So, what are the costs of an ETF, right? So the cost to operate the ETF is essentially called the expense ratio. Um, just think of that as the administrative costs, the operating expenses that's needed to keep the ETF running. Passively managed ETFs are less expensive to manage than actively managed ETFs, and that's just because you do have a manager there that's working every day, um, to keep the ETF running. They're usually in and out of securities every day. So, for example, I'm sure you probably heard of ARK Fund, ARKK, ran by Kathy Wood. That's an actively managed ETF, and every day, every trading day at least, she is trading in and out of positions. So, the weights of the portfolio are changing, and sometimes the names in the portfolio are changing. Usually, when you see something like a passive, most of the time it's just the whatever set of names that was created with the ETF is usually the ones you see, unless something happens like one of the companies in the that the ETF holds goes bankrupt or is acquired, and then you will see a shift there. But other than that, the names in the passive fund usually never change, but it does in an active fund. And what I mean by it's more expensive because she's there every day. So ARC charges 0.75 the last time I checked, so 0.75%, and that's $75 on every $10,000 invested in ARC. And I think I've seen some passive funds like 0.5, 0.4. I've seen 0.60. However, though, it's still less than 1%. You're paying around 1.2%, 1%, around there for, and maybe even a little bit more for a mutual fund. And it's easier to, again, lower barriers to entry. And as far as compared to an index fund, it's roughly around there, a little bit more, but you do have to have a minimum requirement to even invest in an index fund. So that's that. As far as tax implications, um, when you're trading the ETF, is treated just like a stock. So you pay capital gains only when you sell on profit, and then you're able to also take a loss in your taxes as well. If you lost money for the year, if you sold. So if you sold on a loss, same tax implications as a stock. And as far as if you invest in an ETF that pays dividends, you pay dividend taxes just like a stock. So, what are the different types of ETFs, right? So I just put a little image off Google to kind of help visually give some clarification there. And then on the other side, I kind of got those different industries, but I also got like kind of included a few examples. Right, so we can just start with bond ETFs. So bond ETFs invest in a basket of bonds such as municipal, state, federal, and corporate bonds. The example that I provided is TOT, which essentially tracks the 20-year bond. And the thing for clarification with TOT as far as how you trade it, you have to also go and track the 10-year bond itself. So I think it's TNX. Don't get that confused with TXN because one is Texas Instrument and the other one is the 10-year. So I believe it's TNX. And check and see where bond yields are. If you don't know how the bond, as far as value, this works, right? When the usually bonds that are selling off, which means people are dumping the bonds, you usually start to see the yield go through the roof, and most of the time that usually trades above the coupon. When bonds are trading at a premium, you see bond yields crash, and which means it's below the coupon. and then you can kind of, their equilibrium when or at par, as we like to say, when the bond yield is trading at the same as the coupon. So that's that. So for example, let's say TOT was trading at 100 and the yields were trading at, let's just say 3.2%. And TOT fell. So TOT has been declining. The bond yield has been rising. So TNX has been rising. Let's say I bought TOT here at the low and TNX started to fall. Usually you start to see this move start to go back up in the TOT, just because yields are coming back down on the shorter end, but they're also kind of rising on the longer end, if that makes sense. Usually you want the 20-year to trade. You want the 20-year to trade well above the 10-year, right? Because it's if I buy something or invest in something, I want a higher return for the time I'm taking, or for my opportunity cost, right? If I want to be investing in something for 20 years, I want a higher return than if I was investing into something for 10 years. So when you see the 10-year above the 20, usually you're seeing the TOT fall. So if the 10-year is starting to come down, or really the yield starting to collapse, you really want to see either really trade below the 20, but if it's above the 20, you want to at minimum come back and trade at essentially flat, and you'll start to get a yield curve flattening, and that I'll kind of do that in another video. But you want the 10-year trading well below the 20, just because it's less risk as far as time wise, investing into something for 10 years than 20, if that makes sense. So if you see the 10-year above the 20, as a reminder, you'll see TLT collapsing, and if you buy TLT at the low, you're kind of betting on that. Okay, the 10-year is going to come back down and trade below the 20. So that's that. The next one is industry, and so these track industry sectors such as technology, pharmaceuticals, or energy. It also tracks. It can be any industry. It can be technology. It can be cybersecurity, semiconductors, consumer discretion, consumer staples. So many other different industries that you can choose. That's available to be traded. Every industry is pretty much covered. So the two I got here is like jets. Jets is aerospace. It tracks the airlines. It tracks Delta, Alaska, American Airlines, United. It tracks Boeing, which is a manufacturer. It tracks Raytheon. What's another one? It tracks General Dynamics. It tracks I believe Lockheed Martin. There's many other names that's in there, but you get my point. It's more of an aerospace type ETF. So if you want to get exposure to aerospace, instead of buying all of these different aerospace names, you can kind of just get exposure to the whole space by just having one transaction and just buying the ETF. Now, I'll touch on that later in the video, but the other one is Hack. Hack essentially just tracks cybersecurity names. So CyberArk, Palo Alto Networks, Okta, which is OKTA, Zscaler, some other names in there that it tracks. It's Fortinet. There's other names in there that it tracks, but those are just some of the names that's in there. Next one you have is commodity ETFs. So these invest in the physical commodities such as oil, agricultural goods, or natural resources, right? So here is wheat. Essentially, the underlying thing in there is future contracts on wheat. So you can trade wheat. So for example, because of the whole situation that's going on in Eastern Europe, um, wheat the wheat prices are through the roof. So this you've seen a huge move to the upside in this ETF just because of where wheat is currently trading. It's currently trading at a high price, a premium, and the average investor can't afford to trade wheat futures, and that can also be um, a complicated investment for the average investor. So to kind of get somewhat of exposure to trade wheat, you can just trade wheat, and there's a couple other names out there that tracks wheat and other commodities like corn and livestock and uh, milk and cocoa beans and soybeans and corn, you know. But for this example, I just chose wheat. But yes, so it offers that type of flexibility um, and exposure to making that trade, if that makes sense. If you had a belief that wheat was going to go through the roof, you can usually trade an ETF like wheat if you're just not that sophisticated enough to trade actual futures of wheat itself. So that's that. Another one you have is like a currency ETF. So invest in global currencies such as the US dollar, euro, Japanese yen. I'm sorry, in the yuan, which is the Chinese yuan. Um, the one here I chose is UUP, which tracks the US dollar. And as you all know, you know, the dollar has been going through the roof. It's been strengthening against other currencies, which is good and bad. You don't want it to be too strong against other currencies just because of the whole trade thing and the uncertainties in other currencies. You kind of want things and currencies to kind of be leveled out. But yeah, that tracks UUP. Well, UUP tracks the dollar, so UUP has been growing, through the roof. And if you really want to track the dollar, you could just do as far as like an actual ticker. You may not be able to see it on like your newer brokerage firms, um, like Robinhood and Webull and smaller brokerages like that, just because of the complexity of the platform. It's not that sophisticated. But if you have like E-Trade and TD Ameritrade, okay, Thinkorswim, probably Schwab, like you were able to kind of put these tickers in and track them. So you can just do dollar symbol DXY. You can essentially track the dollar, but UUP is it's a currency ETF that its underlying thing is the dollar, if that makes sense. So the next one is inverse ETFs. Inverse ETFs, use a variety of derivatives to make a profit from the decline of a value of a stock by shorting it, right? So for example, QQQ will be the Invesco Technology ETF. S triple Q will be the short version of that. So let's say you can take shares in the SQQ if you believe that the QQQ was going to fall in price. That it kind of be your example instead of either and why is this important? For example, let's say you believe that the QQQ was going to fall in price. A few ways you can kind of handle that. If you want to say, okay, I want to take the short side of that bet, or I want to take the other side. I want to bet that this is going to fall. You can either sell shares short, which you're borrowing shares to sell short, and if the price falls below where that the price that you took it short at, or you bought the shares at, you will cover. You will buy the shares at the price and then give them back to the brokerage, and then be the spread between your profit minus the fees that you use, the fees for the money borrowed, if that makes sense. Or you can trade derivatives such as options. And if you're not sophisticated in short selling or trading options, which if you don't understand how none of those two work, you can lose money if you're wrong. But This is more of a simpler version of that, and you can just essentially buy shares of the SQQ that will go up as the QQQ comes down. So that it's you don't need a lot of knowledge um, to bet the opposite side of the bet, that of the thing that's short. So if QQQ is going up and you think it's going to go down again, let me repeat it. You can just trade the SQQ, and if QQQ comes down, SQQ goes up. If QQQ keeps going up, SQQ keeps coming down. And then you have SARK, which is the short version of ARK, and which has actually been performing pretty well. SQQ, ARK, SARK, SQQ and SARK has been performing pretty well just because of current economic, monetary policy is kind of just putting pressures on equities. Credit spreads are getting wide. Equities are under pressure just because of there's a lot of inflation right now. So the market has just been coming down, and so these things like these inverse ETFs have been going pretty well so far this year. And one thing that's not on this list is, which is the next one, is leverage ETFs, and they're essentially using debt to double or triple the returns of whatever it is tracking, right? So for example, you want to see triple returns on, let's say it's a triple leverage ETF, and T triple Q is trying to get triple the returns of QQQ. So there'll be an example of that, and it uses debt, aka leverage, to do that, and you can't lose money there. But the good thing is all of the actual functionality and work is on the back end, so you can just trade in and out of these as actual shares. And these also have options as well, though the options isn't that liquid on these type of instruments, inverse ETFs, leverage ETFs. You can just simply just buy the share, and that kind of just be the purpose of actually trading the options, but without all of the risk of going to zero if you're wrong. So that's that. So ETFs versus mutual funds, I've kind of already touched on this, but as far as a graphical kind of representation of what I was talking about, you can have multiple holdings in both. Trading on exchanges, only ETFs. Intraday trading, only ETFs. So these ETFs can be traded intraday. You can be in and out just like that. Liquidity is there. Can't do that with a mutual fund. There is a lot of transparency as far as what it's investing in, who the sponsor company is, what's its market cap. There's a lot of transparency there. Expense ratio, again, like I said before, the expenses are generally lower, just because these funds are one, they don't have to do all the work of pulling people's money together, and two, the they don't really make any money as far as the funds. They just make their little fee, and that's about it, and it just covers the basic cost. And again, lower management fees. Management style is typically passive, but I have a chart layer that shows us that there has been a rise of actively managed ETFs, and then there is no minimums to invest in ETFs, so they're highly flexible. So here I just have some graphs, showing ETF inflows versus mutual fund outflows, courtesy of Bloomberg. And most of this stuff we already touched on in previous slides, so I'll just kind of go over this really quick. But I believe these are very interesting to look at, and kind of just give you some insight on where money has been flowing in this market. And if I read this stat right, I believe 20% of volume in this market is coming from ETF trading. So that's substantial. So the Kathy Wood effect is the kind of really the first chart. So active ETF launches now surpass passive debuts, right? Usually, as you know, most ETFs were passive, but you kind of really seeing this shift towards actively managed ETFs, and I guess kind of Kathy Woods is really the poster child for that. Though it does charge a little bit of a higher fee. Um, some people kind of prefer to be in things that are kind of traded in and out of every day. As far as the fund itself doing the trading, and then people are also trading in and out of the actual securities that are available on the open market. So you can really see the weights of what some of the what these active funds are kind of changing. They may be 5% weighted towards here, then they may change to 2%, right? Again, they're trading to make a profit, and then they take that profit, and there's a certain percentage that has to always be invested within this fund, so they can't always sit in cash. So they're always in and out of different stocks every day. One day a stock might pop, they may sell, and then they may go and buy another stock that's probably a little bit lower, and then it's kind of just a whole back and forth thing of maybe they might buy a different company than from the stock that they just sold. So there's that whole passive thing, and some people like that type of style of investing. And again, that's why ETFs are so great, because it does give you the flexibility of whether you just want to go passive, something like an S&P 500, aka SPY, which is the ETF for that from, again, State Street, or you can go something like ARK, and there's other passively managed there's other actively managed ETFs out there, other than ARK, that you can kind of also invest in as well. So it gives you the flexibility as an investor to kind of choose what style of fund you want to invest in, passively managed or actively managed. So that's great for flexibility. But from 2011, when you kind of really had almost not that much actively managed funds, to this whole 2020 thing, when kind of we had the huge injection into the markets from the Feds due to the pandemic, and that's been going down a little bit as far as like new funds being launched, but this number is still high, and you've seen the launching of passive funds decrease, and that the funds go higher. It's kind of essentially better than running a hedge fund, I guess. It depends on what type of manager you are. It depends on what type of person you are. You can do a hedge fund, you can do a mutual fund, ETF. You run an index fund, whatever you want to do as a fund manager. I guess a lot of people are kind of shifting towards this whole, actively managed ETF thing, because it's just better. It's a little bit more, it's easier to kind of really get the market. Just have to raise cash and kind of do the kind of creation step process, and then put have that traded on the open market, which is a hell of a lot easier for some people than doing it the hedge fund route, which is tough business. You're always fighting for cash, and you better perform. Another chart just kind of just shows flow. So ETFs just had the best first half of inflows, best first half of inflows on record. This is kind of by years. Also, disclaimer: this chart is from roughly July of 2021. So that's why you see the second half so low, because the second half had just started then, not too long from the posting of this chart. But this number was relatively still high on comparative to essentially these 2020, right? So first half, second half, huge inflows. People really just like ETFs. That's the best way to go for cash, and people, like I said, the flexibility of it, the tax implications of it, and just the amount of options available into ETF space, which is just so attractive to a lot of investors. Which is why you see kind of this huge rise in funds that are being launched, especially here. Like, people didn't really believe the recovery thing on the first half of 2020, and then the second half was just such an explosion. And then there was a lot of momentum carrying over from 2020 because of the amount of money that was liquidated into the markets to support the economy. So again, you've seen this huge burst in the first half of 2021, just to kind of aid off really what happened from the second half of 2020. So here is essentially the battle of assets. ETFs beat out mutual funds for inflows in recent years. There's always money coming into the market, and it has to go essentially somewhere, right? It has to go somewhere. Money never disappears; it just goes somewhere. You getting this huge, really tug of war that ETFs are really winning as far as in today's age, compared to mutual funds. And mutual funds is just it's more expensive. Your dividends are reinvested most of the time. You don't know who your money is pooled with. You rarely get to really talk to the actual fund manager. Do you have to have a certain amount to really invest in them? You can't trade in and out of them with ease like you can ETFs. Like, this thing just this generation really doesn't like about mutual funds. ETFs is winning. So that's why you're seeing this big number of outflows from mutual funds into ETFs. It really started right around 2015. In 2015, again, back to this Cathy effect, you really seen this huge burst in these passively managed funds, because it was just this whole really new thing that worked. So putting these two charts together, you kind of see how the story played out, right? There was a continuous inflow as far as cash into assets, for these ETFs, starting really from 2015 on up, and from there there's only really been 2 years of inflows into mutual funds. So that's that. And then the other chart I got right here is kind of like the big three. So BlackRock, Vanguard, State Street make up majority of the ETF industry. So State Street would be the whole Spire sector ETFs. So Excel is usually the thing. You'll go SPY, and then XLK, XLP, XLY. 1 second. So here we have the thing that I was talking about earlier in the presentation. ETPs, which is exchange traded products, and you will see like ETFs, exchange traded commodities and currencies, ETCs, exchange traded notes, which is ETN. So ETCs tracking underlying commodities and currencies. ETN is senior unsecured and unsubordinated debt that's listed on the exchange. And the examples, we all know what the ETF is by now: SPY, JETS, XLY, ARC, which is just some of the many that are available. ETCs would be like your just things that tracks the commodities, CL, WTI, NGLE, natural gas, WTI crude, and then just crude. And then ETN to be something like the VIX. And VIX itself just tracks its underlying thing is really just trading the futures contracts for the actual VIX itself, which is the volatility index. And you have to be careful with these because sometimes the sponsors stop issuing new shares, and what happens is when that happens, you'll start to see the ETN start to debase from the actual thing that it's tracking. And we've seen that recently with VIX. Barclays, what happened was they stopped issuing new shares of the VIX for a little bit, and you've seen the VIX essentially have this huge divergence from the VIX itself, and the VIX just went through the roof for like a few days and it came back down. But it has at the VXX. Again, you can, if you want to get exposure because you believe that there was going to be some volatility in the markets, you can't trade as the average investor can't trade the VIX. So the VXX is a product offered to get exposure to volatility that you may believe that is coming, right? And options are also available on ETNs, or specifically the VIX, and you also trade it as shares as well. So you have to just make sure if you're going to trade these complicated, high risk, products, you know, one, who is a sponsor, two, how has this performed compared to the actual thing that is supposed to be tracking anyway. And the VSX is the common one. That's a little bit better than the mini VIX, which is VIXM, I believe. But the VXX has been the main one to trade. So we're coming to the end. So just some of the key takeaways. ETFs have lower barriers of entry to investors. They have lower fees compared to mutual funds, and they're easier to invest in compared to index funds, which requires a minimum. So there is no minimum. They offer a variety of options to industry/sector specific companies and combines them into one fund that allocates different weights to the underlying securities within the ETF. Offers investors diversification within the industry while only holding one security. So again, for example, like jets, you want exposure to aerospace, you could just go and buy jets and you get exposure to all the different aerospace companies, right? And then again, they're easier to trade. They're highly liquid. You can trade them intraday. You can trade derivatives on them as far as options as well, which I do. There's just some of the few key takeaways. Also tax implications. They're treated just like stocks. So that's just some of the takeaways I like about it. Let me know in the comments what takeaways that you like about ETFs. So I just want to do it for today's video. Thanks for watching. Let me know if this helped or not. It's kind of like my first time doing a video like this whole recording presentation thing. Let me know what I can do to improve my video, but also let me know what you learned. I want to help people understand, these different things in the investment space. So let me know what you learned. Let me know what were your takeaways from this. I want to do more videos like this in the future, but if you also want to follow me on social media, I'm trading and kind of really going live as well on Twitter. So that's camp_capital. You can follow me on there. Ask me questions. I'm well into the investment space, so ask me questions there. And I think that's going to do it for this video. So again, I will see you guys when I see you guys, and thanks for watching.